All right. Well, good afternoon, everyone. It's great to be here with you on Wednesday, and today is the 13th of May. Great to be here with you today. I'll give a shout out to Robert and Rojo and Wacky and Simone and Jay Richardson and everybody else that's here today. The bell just sounded. The market has now closed for the day. Speak Truth, good to have you with us as well. Thanks, everybody. Got Barb in the chat. Give a shout out to Barb. Say hello to her. If you want to follow me and Barb on x.com, you can, Scott Thompson CS or at Barb Armstrong CS. And today our topic is going to be sharing a technique that I wish somebody shared with me when I first started. I think many of us feel like right after we buy something, the market goes down. Just kind of curious. Hey, Will, good to see you. Has anybody felt that way? You know, you go buy the stock, it's been going up, 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 or sideways or whatever, but as soon as you buy it, it goes down, right? That's a fairly common feeling. Hey, Olga. Um, so the technique I want to share today is called a buy stop order. But there's more to it than just the buy stop. There's a setup that I want to share with you. And a setup is what the stock looks like just before we get our entry signal or whatever that is. But I want to share a technique with you today that on some stocks that not only have our two green arrow signal, but even in the two green arrow sample trading plan that we've used over the last several months, almost a year now, is still it's common to buy something and then have it go down. And when you're first starting off, that's a tough pill to swallow sometimes. So I want to share that with you today, and hopefully that's helping you to take that first step into the investing world. Certainly, we recommend that you do everything in paper money for now until you get comfortable with some of the risks involved. In fact, before we get going, let me remind everybody that our presentation today is for informational purposes only. The strategies that we talk about, the stocks that we talk about, are not meant to be individual recommendations. We are using the Thinkorswim paper money or demo account, and there are some significant differences in the paper money compared to the live money. Uh, we talk about stop orders all the time. There's no guarantee that the execution of a stop order will be at or near the stop price. We also talk a little bit about fractional shares. I wanted to hit that today just briefly, but there's significant risks and unique risks associated with the fractional shares. So be aware of those before you invest. And then, as always, all investing involves risk, including loss of principal, and past performance does not guarantee future results. So let me go ahead and jump off first here to our YouTube homepage. We'll come back around to this, but we have an 8 lesson series that I taught several months ago now, where we went through lesson 1 through 8, and that's going to be found on our Trader Talks homepage. And if you scroll down, you'll see it's called Stock Investing Basics right here. Stock Investing Basics. These are our lessons 1 through 8 that talk about kind of just starting off, why we invest, how to invest in the stock market, building that mental readiness, creating a trading plan, and so on. And so, if you haven't watched these, or if you're brand new, I would recommend that you go through these 8 lessons and then come back and catch up on the playlist. And if you click at the top here, you'll see playlists. And just we're here in the second line, stock investing for beginners. This is our full playlist that has not only those 8 lessons on it, but also every lesson that we've done. Episode 45 was the one we did last week. And so we're continuing to follow up on those 8 lessons, essentially just implementing the sample plans that we introduced back in those 8 lessons. So let me go over here to our Thinkorswim platform, and I want to summarize quickly what we've been doing. So there's been 237 days. I calculated it this morning. 237 trading days since we started this Stock Investing for Beginners webcast. And our first plan, again, just like if you're right out of high school or right out of college or just starting your investing journey, you may not have a $500 or $1,000 or anything to get started. And so we started with $5 per investing day or trading, or $5 per day. And there's actually about 252 trading days in a year. So if you take 5 times 365, and then divide that by 252, you get $7.24. So $7.24 is what we've been doing. Our plan number one is to invest that $7.24 in something that tracks the S&P 500 and the NASDAQ 100. And there's quite a few different vehicles or ways that you can do that. But that's been our plan number one. And we've been doing that consistently for 237 days now, which is really, really getting exciting. I'm excited to get to the 252 days trading, which is about 4 weeks away. Sample plan number two is we've been investing $50 every week in the top 10 holdings of those tracking instruments. And those you can see right here. This is our kind of plan number two, the fractional shares. We've been buying $5 worth times 10, so $50, but we've been investing $5 a week in the top 10 holdings. And so that's $50 total for the week. And we've done that for 48 weeks. And if I click over here on our P&L open, you can kind of see we started this back on the 9th of June of 2025. And if I scroll down, I did this on Monday again. For the last 48 weeks, we've been doing this together where I'll invest, $5 per stock, and that ends up being these little fractional quantities. And you can actually do this on the Schwab.com platform. It's coming soon. We're hoping here kind of June, July timeframe that you'll also be able to do this type of fractional share investing on the Thinkorswim platform as well. So that's pretty exciting. And then again, remember there's some specific risks involved with the fractional shares that are unique to that aspect. So just be aware of that risk. All right. So then our plan number three, which is what we've been spending most of our time with over the last several months, is what we call our two green arrow plan. And the two green arrow, there's a whole bunch of scripts and codes in our description that have the different charts that we use, this column header that shows how many days above the 50-day moving average the stock has been. We have a column here that says how many days the stock or the MACD has been green. And then if it's red, it just shows these zeros there. I don't have the script built, so it shows how many days it was red. But this is our plan number three, and we've been calling it affectionately the two green arrow plan. And this plan is to just buy uptrending stocks. Generally, we've been focusing on the S&P 100, and we've been using a mock portfolio that's $10,000, and we're investing up to $500 per position. And so that allows us to have about 20 open positions where we divvy up that $10,000. So those are what we're doing here. And so, we're working together doing this. And a few weeks ago, I introduced this idea of determining your market posture as part of our daily routine. So I want to go through that process today. And then I want to show you this technique that I discovered many, many years after I started investing that helps us minimize the chance of buying something and then it just goes down. This technique helps. Doesn't guarantee it by any means, but it helps that it's nice to buy something and then at the end of the day have a profit on it. So that's what we're going to kind of focus on today. But let's jump in first. Go to the charts here, and I'm going to pull up this script is at the top of the chat today. It's also in the description, but I've chatted in this grid chart that I call long-term, intermediate term, short-term trend 3 charts. So it's this grid, and it will come up, and then if you right click somewhere on any one of these charts, you'll see this maximize sell. And what it does is just blows up that one chart. So when you're determining your long-term posture, basically what's the long-term posture mean? It's the long-term trend. And there's multiple ways to do this. It's just how I learned it. I like to use a 10-period exponential moving average and a 40-period exponential moving average on a weekly chart. So we have a 3-year weekly chart here. And this is really simple. If the 10's above the 40, we're bullish. If the 10's below the 40, we're bearish. And so right now, I'll throw a quiz out to you. What's our long-term posture as of today? What is it? Well, the 10's above the 40, so we're long-term bullish. Now, why do we do the posture to begin with is the idea really with market posture or sector analysis or any of that is to try to trade with the trend. So if the long-term posture is bullish and the intermediate term posture is bullish and the short-term posture is bullish, then that increases the likelihood of maybe our bullish trades being, more effective. If we're trading against the trend, or if you've done that in the past where it's like, well, this can't go any higher. It's at all-time highs. It's got to go down, right? Many people think that. And you try to trade against the trend, a lot of times people find that that is less effective. So that's why we do this is to help us, maybe give the confidence that we need to take new positions and things like that. So there's our long-term posture. If you up here at the top, once you've maximized that sell or the chart, you'll see these little arrows. If you hit that next arrow, this is our intermediate posture. And this is, again, how we interpret it is if the 30 period simple moving average is rising, we're on a 6-month daily chart here, we would say our intermediate posture is bullish. If it was kind of oscillating like it was back here in February, we would say our intermediate posture is neutral. And then, here in March this year, that 30 period moving average was falling, and we would have said our intermediate posture is bearish. All right, but right now we're bullish. And then for the short term, this one's kind of cool. You'll see these green and red arrows on here. This is actually called the Williams fractal. And in order to load that separately, go up here to patterns, select patterns, and then you can just go down to the candlestick and type in Williams. And that's what puts those arrows on the chart for you. And then, I would probably have drawn a little arrow right here. Those of you, let me get rid of my little cursor thing here. And let's make it so it's a little easier to see my arrow. But do you see right here, like that candle there on the 1st of May is actually what we would call maybe a shooting star, or it could be a gravestone or tombstone doji where the open and close was, fairly close together. Barb's done a lot of great little short videos on candle patterns. If you go to her trade management mini series playlist, you'll see a whole bunch. There's at least 13 of them there on candlestick patterns and what they mean. But basically, that type of pattern means that we might get a pullback the next day, and we did. It closed below the low of that candle. So, me personally, if I'm doing an interpretation here, I would probably put another little red arrow right there. In fact, we have a drawing. I don't know if you're aware of this, but there's an arrow tool, and you could put one right there and then just right click on it, edit the properties, and I want down and I would want red, which is kind of cool. So I'd probably put a red arrow there because it closed below the low of that high day, and then the next day it bounced. And so I'd probably put a green arrow right there. But what we're doing when we do our short-term postures, we're looking for these higher highs and higher lows. All right. So that's all of our postures. We're short-term bullish, no, intermediate bullish, and long-term bullish. That doesn't mean it's going to continue that way. It's just what it is right now. And so, as part of our daily routine that we talked about last week, we want to monitor our open positions for a sell signal or a stop adjustment signal. So we actually have 4 of them here: COP, OXY, Target, and Ross Stores. These are sessions that are or stock positions that have gone below the moving average. And so our rules for our 2 green arrow system say to adjust the stop accordingly. So let's take a quick look at those. I'm going to go over here to my single chart. This is the chart. This chart is also in the description. If you want to load this chart up in your own Thinkorswim, you can do that. But so our first one was COP. And this one actually gave a red arrow a little while ago, gave another red arrow just about a week ago. And so when the stock kind of bounces around sideways, I don't adjust the stop again until the trend resumes. So this is either going to start trending up again or it's going to stop us out. Our stop on COP right now is at 111.08, which I believe is 3% below this support level that we'd identified. Okay, so no matter what happens with the red and green arrows for the next little bit, until this thing starts trending up, this stop is not going to change. All right. OXY is very similar to this, another energy company. We got two red arrows here on the 6th of May, which was, basically last week. And the stop, we could put 3% below the low price. That's our rule. But we always ask ourselves, if I get a stop adjustment signal, does my stop make sense? And so, if for some reason the calculation says to put the stop at like $53, but we have some support at 52.37, most investors would say, well, I don't really want to get stopped out above that support level, so I'm going to put my stop below that support level. And that's what we've done here. The stop on OXY for us in our sample plan is 51.44. And so again, this one's either going to start trending back up again or most likely will stop us out. And with OXY, we bought this one a few months ago, so our purchase price is actually over here at about $43, $44, and our stop is actually above that. So let me have you chat in here. How many of you like it when your stop is above your initial purchase price? Does everybody like that? And we haven't done anything special here. We're just following the sample plan. And after you've been in this 50-day moving average, this two green arrow plan for about 2, 3, 4 months, usually somewhere along that line, you'll have your stops start to get above that purchase price. All right. And then looks like GLO or HELO, not sure which one that one is. Why do you use a simple moving average rather than an exponential moving average? Well, for this plan, HELO, this is meant to be a little bit longer term, more of an investing plan than, say, a trading plan. And so, when you're starting to deal with a 50 period moving average or longer, the exponential moving average, sure, is going to react to price more quickly. But what we're trying to do here is to give the trend the benefit of the doubt and just stay in that trend as long as possible. So by having that simple moving average, we're getting a little bit slower signal, honestly. And so the stock might have closed below the exponential moving average sooner or before it closes below that simple moving average. And so it just ends up giving the stock a little bit more wriggle room. There's nothing inherently special about a simple moving average or the exponential moving average. They are what they are. Simple, puts the equal weight on every close. Exponential puts more weight on those more recent closes. So, it's a great question. All right. So let's keep going here. We had Target. Now, Target, TGT, this is one that we bought not too long ago here. And what happened? Well, right there a couple days ago, we got red arrows. So let's go through the mechanics of this just to show how it works. The initial stop, we set 1% below the 50 period moving average, and that's what this purple dashed line is. And then if it closes below the moving average, the rule says to put the stop 3% below the low price that particular day, which in this case was 117.67. So let me pull up a calculator here. So 117.67 times 0.97 is where that stop would be adjusted to 114.13. And I think that's where my stop is over here, is I moved that a couple days ago. So the stop's at 114.13, and I just kind of did a visual check. In fact, I drew a line there about 116.83. That's where the last low was. That's where the last short-term support. Well, there was one up here too, but this was a short support level near the 50 period moving average. And so in this case, I thought this stop at 114 made sense. It's below the current support level at 116.83. If we get stopped out, we'll have a small loss, smaller than it would have been had we got stopped out immediately. But the stop on target, based on the rules, is set at 114.13. We asked ourselves if the stop makes sense. It's below the support, so we just let the rule kick in and say, yep, that's where the stop's going to go. Ross Stores is the other one that got a red arrow as well. Now, we just bought this one a couple weeks ago. The initial stop, again, would have been 1% below the moving average, which was there about 202 originally. And then we got the two red arrows here on the 11th. So again, the rule, what's the rule? If there's a low, you guys help me out calculating this one just so I know that you know how to do this. But the low price that day was 211.02. So where would the stop go? If that price is 211.02, and how do you calculate it? And I'll go through it with you here in a second, but giving you a minute to take your own calculator and figure it out. Okay, because basically what we're trying to do here is to help you create some of your own investing rules so that you can be more consistent in your investing strategies and hopefully be more consistent in your your results. All right. So 211.02, if we take our calculator, we take 211.02 times what? 0.97. That's how we get the stop number. And so 204.68, 204.69, depending on how you round that up. And so here I set the stop at 204.68. Again, what's the check? Well, does that stop make sense? Well, I just kind of look for a level of support in the past. And we had a low here on the 30th of March, and that was at 207.48. Our stop adjustment rule says to put the stop below that level, and it is. So, Ross has kept going down, so we're still losing a little bit more money on this. But again, the stop's above the original stop, so we only move it up. And so for the first couple of months that you're in the trade, if you adjust the stop, you're reducing your risk per share that you originally had. And then hopefully, like we did with Oxy, eventually your stop gets above your purchase price. All right. So that's what we're looking at on Ross. So that's looking at our open positions. We've gone through and taken a look at all of them that have the red arrows, and we're good to go there. So now the next part of the daily routine is just looking through whatever watch list you want to look through. And our main watch list has been the S&P 100. Now, I'm not going to run a scan today, but you could certainly run a scan. I said this last week, and I really recommend that you do this at least once a month. But I would like to see everybody, pull up their S&P 100 watch list and just look at every single stock on there. And the way that you do that is you can lock them up. If you have the same color, like I've got a 7 over here. In fact, I need to probably, let me make this a little bigger. I was operating on the medium. Let's go up to larger. Maybe that'll help people see what we're doing here. I apologize, it didn't do that earlier. But what I'd like everybody to do at least once a month is just manually go through each of these and just ask yourself, do I have a valid buy signal on that? And if you do, then write the symbol down and then go back through all of them that have the valid buy signal and say which one's the best one. And essentially that's what I did today is I went through this whole list of S&P 100 stocks, and then I found a couple that I want to share this technique with you. And the first one's Oracle. Now, I know we just traded this one a couple days ago on a breakout over here, but the stock's now pulling back. So I'm going to zoom in on this, and I want to share this technique. The two green arrow is primarily a breakout type of straight trading entry strategy. And so a lot of people feel very uncomfortable buying when the stock's like at that new short-term high. But that's when the buy signal for this strategy often is. But what I'm showing you today is called a buy stop, and it allows you to catch the momentum shift. So, over the last several days, we can see the stock's been pulling down, right? The stock's been going down. We made a new high on the 7th. We came back. And this pattern right here, we have a webcast called Trading Price Patterns. So, if you're a little bit more advanced in your technical analysis, this is called a short-term bull flag. And so short-term bull flags and bull flags in general are bullish continuation patterns. And so what shorter term traders look for and what longer term investors can actually use is the same technique to enter the trade that a short term trader might use. And so I want to go through this with you here. As the stock pulls back, now take out your notes here. I'm going to give you some kind of guidelines that traders look for on this entry. Okay. Now, the stock, when it runs up in a normal uptrend, what you'll often see is about a 7 to 10 day run up in price. And then you'll usually start to see about a 3 to 5 day pullback in price. And that's probably those shorter term traders taking some profit um, as the stock pulls back a little bit. A couple other things to note down here in your notes. Old resistance areas become new potential support areas. So, support and resistance are areas, they're not set prices, but like this range on Oracle between about 183 and 189, I would say, there's our potential support area. All right. And so, put that in your notes. Old resistance often becomes new support. Not guaranteed, not going to happen all the time, but that's what we look for. All right. Now, another kind of thing that's cool in this short term bull flag is we want to see four components. All right. First component is a higher high in the trend. Okay. So the first one here, I'll write these down because I think these are fun to know and practice with. So plan number 3, I'll just write down here, bull flag. Okay, setup number 1 is the stock made a recent higher high. So this last high that we had in the trend on the 7th of May was higher than the last high, which was over here on the 22nd of April. Okay, so we need a higher high. I'm just going to die HH. Okay, number 2. So I said this a minute ago. Let me see who was listening. In a nice general uptrend, how many up days do we have followed by how many down days? What's common? What do we start to look for? Okay. 7 to 10 up days followed by about 3 to 5 day pullback. Okay, so I'm going to write that. And again, this is not always the case, but this is very common when the trends are pretty strong. You get, a 3 to 5 day pullback. If it's really, really strong, which has been frustrating if you watch the S&P 500 and the NASDAQ, is you get like one pullback day and then it takes off again, right? So, but this is kind of the general idea. Number 3. All right. Now, what we're looking for is, because we could have seen this, we didn't know that was going to be the high, right? We didn't know the 7th was going to be the high until the next day. It's like, oh, okay, that looks like that's the intraday high. We're starting to go down a little bit, but that's a green candle. It's like, well, I don't know if that's going to go down tomorrow. And then the next day, you go forward and you're still like, wow, I don't know if that's going to hold there or not. But what we're looking for is a higher high followed by that 3 to 5 day pullback, followed by stock trading near support. Okay, and that might be old resistance, right? So here's that. And Lakshmi says, is Oracle going to make a new year-to-date high before earnings or after earnings? Good question. I don't know. So, as that starts to pull back, and this day right here is the actual day that we close below the low of that high day. There's our low day, and that happened yesterday. And then today we're getting what's called an inside day. But the important part, the last little setup criteria here for a bull flag is a higher low, HL, higher low. So we just want to make sure that this low that we're staring at right now is higher than our last low, which in this case was back there about the 30th of April. Okay. And this is what we call a bull flag setup. Now, some people would say, if you're more aggressive, in fact, if you go, maybe I can just show you this real quick. If you go over to our YouTube homepage and go on the playlist, or you can go to the shorts, but like if you go to the shorts list here, scroll down near toward the bottom, and I did a little short video. It's like 2 minutes long that shows a way that people might trade that bullish bounce. Did it load up? No, it didn't load up that one. So, go down and find that one. It's on the shorts, but it's called, bullish bounce, and it's down here toward the bottom. 3 keys to trading the bullish bounce, and maybe Barb can grab that and put it in the chat there eventually. But this is going over that setup exactly. And some people, when they see that setup, like with Qualcomm, or Oracle that we're looking at right now, they would say, you know what, Scott, that looks like it's a small body candle inside the bigger body yesterday. That's called a bullish Harami candle. And so some people might buy that today and or place an order to buy that because it's a bull flag setup with the stock trading at support, making a higher low and a bullish candle pattern that might signify the stock's going to go up tomorrow. Now, there's no guarantee, of course, that it's going to go up tomorrow, but this is that more aggressive type of way to trade a bull flag setup. But what I want to show you is to put an order above the high of this inside day so that, now this is the reason, if the stock does bounce up tomorrow, that we're going to get into the trade as it trades above the high of this candle, and then we'll it'll activate our stop order, which we're just going to follow our 2 green arrow rule and put our stop down here at where that moving average is. So let me go through the numbers with you here, and I'm going to put a little text box with these different numbers in here. Well, actually, I'm going to use my scratch pad. That'll be a little easier. So this will be on Oracle, and then we'll do one more example, and then we'll be done today. So on Oracle, ORCL, the entry price. Now, you guys are going to have to come up with your own rules here. I'm just going to throw out some numbers, okay? That, there's nothing inherently special about these, but if the stock trades above the high of this candle, which is at 191.57, and I'm going to say 20 cents. If it goes to 191.77, I want my buy order to trigger. Okay, so 191.77. Now I know many of you are thinking, well, that's really, really close. It is pretty close to the high, but it's how far away from the close? The close was at 189.76, so the stock's actually got to go up about $2 before it's going to trigger that entry. All right. So again, nothing inherently special. Some people use 20 cents, some people use like 0.5%, some people might use $1. But the idea is we're trying to get in there as quickly as that momentum starts to shift. And this is another cool thing here on the technical side. But you notice how the high on the high day, the high the next day, the high the next day, the high the next day, and the high today are all lower than the previous high. On the rally, this is so common. The low, higher low, higher low, higher low, higher low, until what? Until the momentum shifted. So all we're trying to do with this technique is catch that momentum shift. And we're basically just saying that momentum shift is defined when it starts to trade above the high of the previous day. And in this case, tomorrow, today is going to be the previous day. So that's why we're using just a really close number there above that. All right. Now, the stop in our case here is going to be down near where that 1% below the moving average, 160.72. And that's going to be our stop. Now, we don't have time to go into it, but I'm going to give you an assignment to go watch Barb's sessions where she talks about bull flags. She talks about them on her Monday and Friday class, but she'll teach you, and so will James Boyd, how to set a target for the short-term trade. And I'll give you a hint. It's this last movement. So, but for our class, because we're stock investors, we're using a short-term entry signal to kind of catch some momentum. So maybe we don't feel as bad if we buy today and it goes down a little bit tomorrow like it did a week ago, right? All right, so let's place an order on Oracle, and then we're going to kind of follow our normal rules. We bought 2 shares of this already, so if I buy 2 more shares, it's kind of like that $500, but we're going to have about $1,000 in this trade. But let me show you how to place this order, and then we'll do one more example. So we're going to right-click, there about where our entry is. We're going to do a buy custom with stop. Let me shrink this. Well, I actually need that in there. We're going to go with 2 shares. We're going to lock that together. So buy 2, sell 2. We're going to go in with an order to get in at 191.77. Now, where did we get that number again? It's 20 cents above today's high. And we're going to, now, is it a limit order or a different order? Well, it's going to be a stop order. And we'll make that good till canceled because we don't know if that's going to fill tomorrow. And then what happens if it goes down again? Well, then we just adjust our entry price down to 20 cents above the high tomorrow. And we just keep doing that as long as what? As long as the trend is intact and we still make that higher low. All right. Now our stop based on our two green arrow rules at 160.72. And we're just going to unlink that. We'll make it a manual stop there. 160.72. We want that good till canceled. And now we have our order. We hit confirm and send, and we just double check our numbers. I want to buy stop at 191.77. We look over here at our notes, 191.77. Our stop's at 160.72. Of course, no guarantee to get filled there. This is going to go in our two green arrow group, and we're putting about 379 bucks in there. All right. So we'll send that order off, and now I got a working order for tomorrow. All right. So let me see. I'm just checking to see if there's any kind of questions that have come through. I don't see any. If I missed one, Barb's done a great job of answering those questions. But if I missed one, then please just chat it back in, and then I'll go back through after our session's over, and I'll take any question that doesn't have an answer, and I'll put it in the YouTube comments on the archive here. All right, let's do one more of these, and I'll have you help me through it. The other one that was in the S&P 100 list is Qualcomm. And this is another one that we own. All right. We bought Qualcomm on the breakout over here. And fortunately, the stock just went up afterwards, which was unusual and nice, right? So we actually have a little profit on our current Qualcomm position, which is, right there. We're up about $24 on our one share that we bought. And so we've got that same picture going on. You can kind of see here, we had a little 2-day pullback going into this big, looks like a bullish engulfing candle. The last low in the trend was on the 5th. We had 1, 2, 3, 4, 5 up days. So we didn't quite get the 7 to 10 up days. We got 5. But some of those look like with the gaps in there, that's about what a normal 7-day run probably would look like. We're sitting on a 2-day pullback. We may want to wait to see it if it comes back closer to the old resistance level that I have drawn in here, about 187. But again, one of the advantages of this type of order is if the stock goes down, guess what? That order doesn't fill. We're not in the trade. We're not losing money. And then we can just reset that order the next day. All right. So let's kind of do the same thing here. We have a bullish Harami candle. This may be where the support is tomorrow. I don't know. Might keep coming down. Don't know. Don't really care. All right. All I really care is if it goes back up, I'd like to add another share to it. That's what we're going to do. So, or in this case, 2 shares. So we'll go over here and we're going to right click. So where's our entry? So if the high's at 219.49, based on the rule I just shared with you, where would our entry price be for Qualcomm? Same rule. We're just using a set dollar amount in this case. So 219.49. If we do this on Qualcomm, the entry, we take 20 cents and add it to the high. So 219.49 plus 20 cents, 219.69. That's going to be our entry trigger, 214.69. Oops, 219. So that's going to be our entry price to get in. Now, where do we set our stop? Well, we set our stop kind of, again, based on our rules. Our stop's going to go at 145.02, and that's just based on the 2 green arrow rule that we're trading for our investment, not a short-term trade. So what was that? 145.02. Okay, and I think the reason that we did 1 share last time is because the distance between the stop and the entry was about 50 bucks, which we're again here. So I'm just going to add 1 share on this trade because sometimes if you buy well above that stop price, we're also have a stop rule that says we don't really want to lose more than about 50 bucks per trade. All right. And I know I'm adding to this position, but these are the 2 that had these really cool bull flag setups. So let's go ahead and right click, buy custom with stop. We'll do 1 share. We've got that locked up. Our entry trigger price we said was 219.69. Okay, not a limit order, it's a stop order. And I don't know if I changed that. Did I change that last time? I'll have to go check that. And then we have our stop at 145. I'm going to unlink it. I'm going to put manual here and go 145.02. And make that good till canceled. So now we hit confirm and send. We have a buy stop order that says 219.69. We have a sell stop order at 145.02. And just like a sell stop order is no guaranteed that we get filled at or near 145, a buy stop order could be problematic. Let's talk about that for just a second as we kind of wrap up today. What's the challenge of having a buy stop order above today's high? Well, in this case, this stop says, hey, Mr. Broker, stop. Don't do anything until Qualcomm trades above 219.69. And then here you go, blank check. So that means this order means if it opens at 219.70 tomorrow, it would trigger that stop order and then create a market order to buy that at the next available price, which would probably be close to that 219.70 or whatever. But what if that opens at 240 tomorrow? What if there's some really good news overnight? Yeah, CB says, what if it gaps up? What if it opens at 240 tomorrow? Are we going to get filled at 219.69? Probably not. Probably going to get filled closer to 240. So let me show you again another little technique that's helpful in this type of scenario. Let's edit this. Is to use what's called a buy stop limit order. And that way you get to decide, well, the most I want to pay for this is maybe 220.69. We'll give it a dollar window here. And now what's the disadvantage of doing this type of order? Well, if it opens at 220.70 and then just keeps going up from there, we're going to miss this trade. And so that can be frustrating. So here's what I want you to take away from this. A buy stop will trigger that market order. And if it gaps up, just like CB says there in the chat, we could pay a lot more than we expect. So as part of that daily routine, which now we're expanding on the daily routine a little bit, if I have this type of working order, if I have some buy stops or some buy stop limit orders, my job would be to maybe go in before the market opens and just see kind of what the bid and ask prices are. Are those quoting significantly above my entry price? And if so, am I willing to pay a little bit more to get into the trade? Or do I want to let my buy stop limit order just sit there? So that's a step that you'll want to add to your daily routine, is to check your buy stop orders or these working orders to see where the market opens are going to be. All right. And so let's go over here. Qualcomm 220.69 with a maximum of 220.69 with a trigger at 219.69, which is what we said over here. We're going to have a stop order kick in once the buy order fills at 145.02. And that's just a regular sell stop order, no guarantee to get filled there. We'll put this in our 2 green arrows, and then we'll send this order off. All right. And so this is an interesting way or a fun way to maybe try to catch momentum as it shifts. And then if the stock comes down tomorrow, we'll just move our entry price down. The stop's going to probably stay about where it is, but that entry price will come down. And if it gets down near the 187.88 range where the old resistance was, then we still have that valid setup as long as it's higher than the last low in the trend here. All right, let's go over what we've done. So what did we do today? Well, first off, we placed a couple new orders. We did a buy stop market order without that protection on Oracle. So again, our job tomorrow morning is to check to make sure Oracle's not opening up at $200. We may not want to pay $9 more per share on something like that. And then we did a trade on Qualcomm with a buy stop limit saying, hey, we'll buy this within $1 of our trigger price. But if it opens higher than that, then we'd have to reevaluate. Do I want to pay 221? Do I want to pay 222? Where is that limit really for me on my trade? All right. We also went over our open positions that have the red arrows on them, and we showed what the stop adjustment would be and where those stops are currently on those particular positions. All right. So again, kind of wrapping up here. I don't think there's any more questions. If you haven't subscribed to the channel, please do so. If these are helpful for you, please share them with somebody. Man, I wish somebody would have told me some of this when I was 20. So anyway, hopefully that's helpful for you, everybody. Have a great, great day, and we'll see you next time. Thanks, everybody.